world economy has changed drastically since the coronavirus outbreak, and real estate markets have not escaped its impact. We've seen several existing trends that have been magnified and accelerated. I will shortly address each of the key real estate sectors and how we forecast each closing out the year and moving into 2021. The retail sector has been especially hard hit during this pandemic. Many businesses have been forced to close as their revenues were substantially lower and could not keep up with fixed costs. J.Crew and JCPenney are notable examples of this trend. In addition, there has been a substantial increase in online shopping. Amazon's revenue during coronavirus increased by 26% year over year. We expect this trend to continue in 2021. Within a 5-year period, online sales could account for 50% of all retail spending. We anticipate the retail sector to continue to suffer. As such, RE Wealth Advisors does not advise buying retail assets in this market. There is, however, substantial opportunity for investors that can repurpose retail space into alternative uses. For instance, we have a customer that was able to successfully repurpose a Kmart store into a self-storage facility. This type of creative repurposing of retail space is recommended. The pandemic meant a sudden and disastrous hit for the hospitality sector. Hotel construction and expansions were in many cases put on hold, with lenders largely shying away from new projects. While easing of restrictions have led to increasing revenues over the last several months, there is still substantial concern going forward how restrictions will impact the sector. The potential for new outbreaks of the virus loom large in hospitality operators' minds. RE Wealth Advisors advises against investments in the hospitality sector outside of clear bargain buys. The rapid global shift to e-commerce caused by the pandemic has seen warehouses and logistics centers receive a timely boost. E-commerce increases demand for space because online retailers must stock a wider variety of products to match consumer demand. The e-commerce share is now as high as 40% of the retail market, with lockdowns accelerating the shift. Consumers who realize the benefit and convenience of e-commerce during the pandemic may not be rushing back to Main Street anytime soon. A gradual shift in working patterns before COVID-19 meant we were already seeing fewer and fewer companies looking for traditional long leases, opting for more flexible working space. As a result, co-working space providers have surged in recent years. Now many commentators are heralding the success of remote working during the pandemic as the dawn of a new work-from-home era. The need for office space and the accompanying large overheads will undoubtedly be questioned by businesses that manage just fine with remote working staff. The property industry is all about people, and apps such as Microsoft Teams, which, while incredibly useful, do not provide face-to-face contact. As things slowly creep back towards a semblance of normality, we will likely see a mix of new and old. Companies will be looking to keep some office space, but perhaps reduce the size as they allow for more remote and flexible working. Firms may look for buildings where they can better control the environment and ensure the well-being of their workforce. In some cases, expanding space to allow for greater social distancing. RE Wealth Advisors recommends a wait-and-see strategy for the office sector as we move into 2021. Multifamily real estate has continued to fare well in the post-outbreak economy. There are concerns regarding non-performing tenants due to government-mandated restriction on evictions. However, the majority of tenants continue to pay, and we anticipate an easing of restrictions in 2021 as the economy begins to return to pre-COVID levels. Section 8 tenants are at a premium in this economy as payment is guaranteed via government subsidy. Demand is high for units and builders are taking on new projects. Here in Florida, we are seeing historically high demand for housing. Multifamily units are a strong play at this moment in time due to extremely tight residential real estate markets that leave many continuing to rent as opposed to buying. Due to historically low interest rates, people are buying houses at high volumes. Realtors can attest to this, with many properties coming at or above asking price. There is a regional context to this trend, with areas in the south seeing an influx of buyers and certain areas in the north that have been adversely affected by COVID seeing a net deficit in residents. RE Wealth Advisors does recommend buying residential assets in the short term as a cash flow play, and also recommends targeted multifamily investment in this market. We hope you enjoyed this real estate market evaluation. Please visit our website at www.rewealthadvisors.com to learn more, or find us on Facebook, Instagram, or Twitter. You can reach us at 954-998-4415 to schedule your own personal consultation.